Hello everyone and welcome to the 12th episode of Your Money, Your Taxes. My name is Lalit Abichandani. I'm the owner of ABIC CPA Associates in New York City, and with me today is Paresh Shah, CFP, a Certified Financial Planner. He's the CEO of Paresh Shah Financial Services. He's Certified Financial Planner and a wealth strategist for the past 17 years, helping individuals and businesses co-create innovative financial strategies in insurances and investments. He's licensed CPA presenter, educating CPAs as they guide their clients in the investments, disability, long-term insurance. He specializes in pension and profit sharing plans, asset protection, estate planning, and business succession planning. Paresh graduated as a chemical engineer from prestigious IIT at Kharagpur, India. His strong sense of professionalism and community service has kept him active in India as well as here in the United States. He supports healthcare education initiatives for the financially challenged. Paresh resides in Long Island with his wife Shimal and with his son Shamik. Paresh, in the last show we have spoken about disability income insurances. At the conclusion, you spoke about why is it important. Could you please repeat for our viewers again, why is it important to have disability income insurance?
First of all, thank you Lalitji for that very warm introduction. There's the central concept that we have been discussing right across when we've been discussing insurances has been human life value. That means our ability to go out and work and exchange that for currency. When that currency comes in, we use that either for expenses or for wealth building. And so if we are sick or injured and cannot work, then not only do we stop the process of wealth building, but we in cases it actually leads to wealth depletion or wealth diminish. And I would like to explain this with an example. There was this couple that I met about 4 years ago. 5 years before I met them, they had bought their first home. So that's 9 years ago. At that time, they had their son they had one child, their son, who was about 2 years old at that time, and they just moved into their new home, all excited. But the challenge with that was that all their reserves were depleted and they did not have any cash on hand or very little assets because all of it had gone into the down payment for the home. Unfortunately, within 6 months of that, he suffered a injury which kept him out of work for about 15 months. Now, his income was about 60K per year. Her income was about 85K per year. So one would imagine that since she had 85,000 income, they would be fairly well off, and or at least they would manage to tide over this 15 months. Well, that really didn't happen, Lalitji. What happened was that because she had to take time out to take care of the child as well as to take care of him, she had to take a lot of days off, and even eventually she lost her job. After she lost her job because of lack of income, within some time they had to foreclose on their home, and they lost their home also. When I met them, he had recovered and they were just coming back on track. I helped them through the process of paying off all their debt, and eventually now they've started saving money again. In a couple of years, they'll be ready to buy their a home again, while their son will be about 13 or 14 years old. Now, all this could have been protected if they had had some disability income insurance, which could have provided them income in the time when he fell sick. And as you can see, the lack of this has put their family behind by about 10 to 12 years in their wealth building or in their creation of wealth. So what I'd like to say is that yes, disability income insurance is one of the central things that everyone should have.
Thank you, Paresh. I understand the importance of disability insurance in sickness or injury. But how about loss of life? I mean, that could be drastic as well.
Absolutely, Lalitji. I mean, the loss of life it can have worse or consequences, because you see, when a person gets sick or injured or is disabled, What happens is that there is the family at least has hope that that person will recover and he'll come back to the family, he'll start working again, like in my previous example. But death is like a full stop. I mean, the family loses a person whom they love, they are in grief, that person is never going to come back. On top of it, all the economic activity that that person would do for the purpose of wealth building, that itself is lost forever. I'd like to give you my own personal story, Lalitji, and in that, my dad was an entrepreneur, and of course, with his business and his work, he was constantly in the process of earning and creating wealth. Well, he did have a health challenge in the heart attack, and that kind of put him back by a couple of years, but fortunately, using his skills, he was able to come back. So though he did not have disability income insurance, the family could manage it through that period of time. But then what happened, he passed away at the age of 54, and at that time I was 21 years old. That left my mom, who was a homemaker, in charge of the finances as well as running the home. And in turn, she had to deal with her own grief. Now, this was a very, very tough phase for us. Fortunately, my dad did have life insurance, and that money came in, and my mom was able to invest that in CDs. At that time, Lalitji, CDs did give interest, okay, unlike today. So she was able to invest that money in CDs, take the income, and run the family till we were in a better position with my income, because I just started my career at that time. So I've been a beneficiary of this life insurance, and as you can see, death, I certainly relate that the importance of disability, and then followed by having disability income insurance, and then having life insurance to protect the family.
But Pareshji, I often find my clients confused about how much life insurance they should have, especially because the premium is, when you're young, there is always an issue of premium. How much premium do you want to give for your life insurance? So is there a scientific way that families can determine how much life insurance should they get?
Lalitji, there is, but I would like to first take it with an example from another area where most people buy their first policies, which is as soon as they get their license and own their first car, they buy an auto policy. So I'll take the example of that. So Lalitji, let us say that you bought a car worth $100,000. Naturally, you would purchase an auto policy to pay in case of an accident, correct?
Yes, absolutely.
Now let us say that that car got totaled. Would you want the insurance company to pay you part of the value of the car, or would you want it to pay the whole value of the car?
No, we are covering the car, so we want the full amount.
Right.
The insurance may not give us, but we would want full amount.
You would want the full amount.
Yeah.
Let us say the car is 2 or 3 years old, and that's when it gets totaled. Do you still think that the insurance company would give you the full amount?
They normally give you book value, which is the depreciated value, in my opinion. Yeah.
Right. So we've established that you would want the value of the car on that given day. That means there is an economic loss to you, and you want that covered up. Now let me take a very, very hypothetical situation to explain to you what is life insurance value that is set by an insurance company. So let us say that you bought this $100,000 car, and now you said that, okay, insurance company, I am willing to pay you whatever premium you want, but in case my car gets into an accident and gets totaled, then you should pay me $200,000. And you're ready to pay whatever premium that it takes in order to attain that. Would the insurance company give you that insurance?
I don't think so. You cannot insure more than the value of the item.
Exactly, Lalitji. You hit it on the nail. So there is an economic value. Insurance is meant to replace a loss. And so you cannot insure for more than the value. And the insurance companies are pretty good at finding methodologies to establish this value properly. So let's now relate that to life insurance. When we relate it to life insurance, you have a person who is, as we talked about human life value, he has this ability to go out to work every day and produce money. Now that currency that he is producing, that can be calculated, and that is an economic loss to the family. So the insurance company will say that, okay, if a person A has this economic value, then you can only insure against that. That is the maximum amount for which they will give you the insurance. And that is also the recommended amount that a person should take. That means that you should ensure that whatever your family loses in terms of the economic benefits that you bring should be replaced to the family.
But how is that all determined? It seems pretty complex. Most individuals don't know these formulas and values.
Yeah, you're right, Lalit. It is a little complicated. Human life value is a complex calculation. But insurance companies, it's one easy way to do it would be you just go to an insurance company, give them your age and your income, and based on that they can estimate the number of years you have left to work, and based on that they would be able to come back to you and tell you that this is the maximum amount of life insurance that you can get. So that's a limit to that. On the other side, there are also some simple rules of thumb which permit you yourself to calculate. So if you are in your 20s, then the life insurance that you can get is 30 times your income. If you are in your 30s, then the life insurance that you can get is 20 times your income. If you're in your 40s in terms of age, then you can get 15 times your income. And if you're in your 50s, then a rule of thumb is you can get 10 times your income. So let us take that a person is 35 years old and has an income of $100,000 a year. Well, if he's 35 and $100,000, that means he's in his 30s. 20 times $100,000, that's 2 million. That is the maximum life insurance that an insurance company will issue to a person, and that is also the recommended amount that that person should get.
But if he works, let's say he's 35 years old and he works for 30 years and that's $3 million, is that the right amount, or should the person go with $2 million?
Your question is correct, and I'd like to just explain it. So here we are talking about the situation where we want to replace the income, but we are giving a lump sum amount. So if the family gets this $2 million lump sum amount and they can invest it at 5%, then they would get $100,000 a year from 35 till 65, till that person is supposed to retire, and that effectively replaces his income. So the central concept of human life value is human beings go out, work, and exchange that for currency. The currency that they bring in, that same currency the family should get in case he passes away. Instead of him bringing in the currency, it is the interest or the income on that lump sum pool of money that brings in that income. So we now have the situation of $100,000 of income coming from that $2 million.
But again, the $100,000, there will be some amount of taxes or the inflation. Because of the inflation, their needs might increase. So is that factored into these decision making when you have major bites of inflation coming into the place, and $100,000 may not be enough?
So Lalitji, yes, inflation does play a major role. But what happens is we can effectively deplete the capital. That means that, so we have this $2 million and we have 30 years to consume it, plus it is earning 5%. So effectively each year if we take some portion of the capital and draw that $100,000 increasing each year, eventually you will run out of money, and you will, by the time 65, so that entire 100,000 plus inflation that the family would get in terms of increasing income would be replaced to the family. So pretty much this calculation is pretty much takes care of inflation by itself.
Pareshji, you explained it and it sounds so simple, but I have a lot more questions into this. I don't think we have the time today. With your permission, we will continue this discussion in the next segment or next areas when we are sitting down again. Hopefully we'll meet in 2 weeks and we'll continue these questionings again.
Thank you, Lalitji.